Hi guys, this is Mark Shaw's in the Pattern Trader. As you can see, I'm just chilling in my backyard. We've had a tremendous couple of weeks of unprecedented volatility. The biggest volatility that I've experienced in 3+ decades of trading the markets, where you had the VIX, which is a volatility indicator in the stock market, go over 80 for the first time. You had oil go down to its lowest level in 18 years. You had enormous round turns in the gold market. Gold went from 1,700 to 1,450, and now it's back to 1,650. And so you've just had these gigantic swings, and usually people associate volatility with some kind of evil thing. To me, volatility just pushes markets where I think that, or where they indicate that they were going to go anyways. And in this last couple of weeks, I've just really banged it out. Never seen such a big growth in my account in such a short amount of time. Shorting the stock indexes, shorting the dollar yen, shorting gold initially, and doing a whole bunch of other things. But I realize that there's a time for everything. And to me, when you assess a trade, you have to assess a trade based not only on the opportunity, but on the inherent risk of that trade. And now that you've had these giant trading ranges where the Dow went from 29,000 to 18,500, where gold has gone from $1,700 to $1,400, and now it's $1,600. Gold has been swinging $100 a day intraday. You have 1,000-point swings in the stock market. And so now it makes trading much dicier. I like to catch a trade right out of the chute, where I see a pattern emerging, then I see either a key reversal, an inside day bar, what I call my insurance day bars, where there's some setup where I can see that the trade is coming out of the chute, where the momentum's in my favor, and where I can assess my risk. So now you have these markets that are effectively in the middle of the tennis court. And for those who don't play tennis, really in tennis you have to be at the baseline or the net. You don't want to be caught in the middle. And so, for instance, now with the stock indexes, you are a third of the way off the lows. You made 11,000 drop in the Dow. Now you're 4,000 off the bottom. And the market can literally go, anywhere from here. So in order to assess a risk reward, I'm going to let things consolidate, slow down, and then reassess. And so you don't have to swing at every pitch. You need to wait for the market to come to you. And if you're chasing these huge ranges and you're unable to assess your risk, you're likely going to get hurt, because even if you're right, the swings are so vast, so big, that it's going to shake you out before you are able to take advantage of that. So certainly, like gold, stock market, the big swinging ticket markets in the last 3 weeks, I'm just waiting for those to settle down and give me a signal. In the meantime, I'm concentrating on smaller trades in other markets where you haven't seen that volatility, and I'm trying to get a foothold there. So again, wait for the market to come to you, and don't chase the market. And this is certainly an environment where you can get caught if you don't heed that warning. I don't want to be arrogant and say a warning, but you know what I'm saying. So listen, I hope you guys have a healthy and prosperous trading day, and I'll speak to you next time.